We don't consider that the sovereign crisis is completely over and is fixed. The European situation is improving and is stabilizing, but there are two countries where we are not comfortable on, and the first one is United States, where the fiscal cliff has been avoided, but the budget issue is not solved, and they still have to find an agreement on that. And the second country is Japan, where the government, despite being one of the most indebted countries in the world, the government just announced a new program to stimulate its economy. So we consider that the attention of the market this year may focus on those two countries, even if it will be less deep than the sovereign crisis in Europe. We consider that after the sovereign crisis, we may have a currency war. It already happened with the Swiss National Bank in 2011 when they implement the floor. And recently Japan has announced that they also wanted to depreciate their currency. And we also know that many emerging countries would like to depreciate their currency, as it's the only tools that they still have to gain some competitiveness. Fortunately, the situation in Europe is not really bright. The government still have to implement the austerity program. The consumption will remain weak as unemployment rate is still rising, and inflation is also relatively high. So we do not expect growth to be very pronounced in Europe. In the best scenario, we expect stabilization with a downside risk. In the United States, the situation is a little bit better, as they benefit from the gas shale revolution, and the unemployment rate is declining, and the most important is the housing market, which is recovering, and this is a very strong support for the consumption in the United States. So we expect a smooth recovery in the United States, despite we still have to be cautious on the fiscal issue that may be a downside risk for the economy. Today the bond market is quite expensive, and mainly on the credit. And we would recommend investors reducing the credit exposure in that portfolio. While it was very good to increase the risk in the portfolio in 2012, we consider that this year it will be less favorable for credit, and that's why we are more cautious on it.